prudent that we look back at 2025 and kind of reflect on what has happened. So in a nutshell, it's been quite modest. House prices have not increased massively, they've not decreased. We've seen about 2 to 4% increase across the UK, but this hasn't been uniform. So there has been a huge north-south divide. Northern properties and in the Midlands, they've increased by 4 to 6%, whereas London and the south have actually stayed the same, or in some cases in central London especially, they've decreased. Obviously, we know that central London property is extremely expensive, so that might not actually be a bad thing. In terms of supply of property, it's actually been the highest it's ever been over the last 8 years. So there's more supply, and that's probably due to a reduction in demand over that period. Mortgage rates, obviously from their huge peak at 2024, have slowly started to reduce, which is positive for all investors and all buyers. In terms of affordability, we've also seen wages increasing at a faster rate than property prices, which has had a positive impact, especially for first-time buyers who are finding property a little bit more accessible to buy. For investors, the rental market has, again, like the property prices, had a more modest increase. We've seen around a 5% increase across the UK and higher rates of increase in the north. Again, that is very positive considering the huge rental increases that we've seen over the preceding years. And obviously, with interest rates lowering, it's going to be more cash in investors' back pocket. So if I was going to summarise it, it's been stable, slightly subdued, but 2026 seems to be shaping up for a good year. So despite it obviously being a modest year in property, we have seen some quite key changes, haven't we? So it might be worth you just running over them. Not in too much detail.
Of course. So we can't really go over the changes that have happened in 2025 going into 2026 that will affect the property market beyond that without mentioning the Renters' Rights Act. So this will be one of the biggest changes the rental market has seen in recent years. Now, there is a lot of detail on this, and we actually, in the previous webinar in this series, we addressed all that in kind of a high amount of detail. Now, there is a fair amount of change, so for any landlords, it is best to consider using an agent who will have the expertise there to handle everything. So feel free to get in touch with our lettings and management team for kind of bespoke advice on that kind of subject. Now, the other big change going into 2026 and beyond is actually the taxation changes that were announced in the budget. Now, this mainly has implications for landlords with properties in a personal name. But what is actually shifting? So from April 2027, income tax rates on property income, as well as savings and dividends, will increase by 2 percentage points compared with standard income tax bands. So this comes out as 22% for basic rate taxpayers, 42% for higher rate taxpayers, and 47% for additional rate taxpayers. So planning in 2026 needs to anticipate that future squeeze on rental profit. So do I hold, do I sell, do I buy something else? And for landlords using limited company purchases, there will be no change in taxation. So this will push many investors that aren't doing it already towards limited company structures instead of buying in their personal names. Now, there has been a change happening over the last couple of years with holiday lets. So by 2026, most holiday let owners are going to just be taxed on rental income like standard residential landlords. So there's now incentives coming to an end. So it's less incentivized to hold holiday lets in your personal name. So there's no relief for capital gains tax, for example. So all this means is when buying properties for short-term lets specifically, make sure they stack up with these tax rules and with ASTs as well. So just to dive into a little example of where these tax rates are actually charged, because it's slightly different in a personal versus a company structure. And we did actually have a question about this leading up to the webinar. So personal tax is actually charged at the rental income stage. So on the rent that is taken from the tenants. That's before management or mortgage cost and he is taxed at the rates that I mentioned before, so the 22, 42, 47% based on your tax bracket. Now, the company tax structure is slightly different. So the company is taxed on the profit after the management and mortgage cost. And now this is done at a rate of 19% on profits under 50,000, going up to 25% on profits over 250,000 on kind of a sliding scale. So what this actually practically means for most landlords and the implications for your strategy going forward. So landlords who run portfolios like a business with tight systems will be at an advantage this year. So for many landlords, that will mean revisiting their holding strategies, so personal versus company, maybe holiday lets versus standard buy-to-let. And then the big one, as always, is location and asset choice. So there will be now going forward in the Renters' Right Act, there will be stronger enforcement of rules against poor quality stock. So for example, stock with low EPC ratings, for example, civil penalties, against older conversions, borderline HMOs, non-compliant small blocks. And these are starting to then look less attractive versus good spec units in regeneration and high employment areas from this year going forward.
Brilliant. So, yeah, I mean, looking now towards 2026 and, from time constraints, we're going to just touch on a couple of developments that we're watching very carefully. But before that, it's just probably worth pointing out that, on a day-to-day basis, and when we're obviously trying to find the best investment opportunities for our investors, there's a variety of different factors that we're analysing. But there's probably two types of factor. The first one is the kind of uncontrollable, more frequent factor, which is your interest rates and your taxation. We have a yearly budget, and there's obviously bad news, and the media is catastrophizing what's going to come out of the budget, and often that has a negative impact on the property market because not savvy investors or home buyers are impacted by that news. We try and get people to stay away from looking at that and making decisions based on that, because although it's important, you're not going to change it, and every single year there's going to be that sort of news. What we look for are the more stable factors, the factors that are not changing all the time. It's stuff like your regeneration projects, which can take 10 to 20 years to be implemented, and they don't stop. Your transport and connectivity, employment, how's that been impacted within a city because of your generation and transport, the economy of towns and cities, and obviously education, which is also a really important factor. So from these two, I think the two that we're going to discuss in a little bit more detail and obviously give some real key examples of where we see some exciting news coming out of is transport and regeneration. So firstly, transport. It's a huge driver of property price growth, and that's because obviously connectivity is just helping the economy. Ultimately, transport expands the labour market, so it means that employees have a much larger pot of jobs that they can be applying for and working within different sectors. But it also means employers have a much larger employee base to be choosing from, because they can obviously commute into wherever their office is located. A higher talent pool obviously means increased productivity, which means better wages, more output, and essentially more money. Furthermore, transport, it reduces business costs. When it reduces business costs and we can get better talent, it means that there is a higher productivity, which means higher wages, which obviously means higher demand, which obviously then means people who can afford higher rents and higher property prices. So ultimately that does mean that your properties in them locations are going to be increasing. Another good point is better transport links obviously attract higher value sectors, and much like the previous point, it means that there are more employees to choose from. It means higher wages, and the demand does increase because when you get your finance sectors and your tech sectors, which are seeing other areas of the UK which are now better connected, and they can open offices there and they can easily be accessible, and they've got a better talent pool there. It just means that there's going to be better wages, and obviously that's going to increase what people can spend on property. So that's obviously a huge driver of increase in property prices. And finally, I'd say that regeneration is it's a lot more buoyant in areas where there are good transport hubs. Again, it's because employers know that their workforce can get to and from the office. But obviously, these transport hubs and what the impact has on property prices is not uniform. So you need to be careful in what you're analysing and how you're analysing that. So, for instance, what is the distance to that key hub, which is then linking the different cities and towns where there is a larger economies? What are the time savings on the journeys from them hubs? And can them areas access high value destinations such as obviously employment hubs, but also your airports, your universities? Can people get to them quickly? Because that there makes these areas more desirable, and it does increase property prices. So it's important that you understand that. Obviously, we do that every single day, and we're always there to assist with giving advice on these key areas to invest in. So looking at what news has come out, and and we've been discussing a lot in the office, it's only, there have been talks about it, but it seems now that there's some concrete evidence that this is going to happen. It's going to have a huge impact on the UK, and especially the north. So we all know the Northern Powerhouse, the belt of cities and towns which runs across the north from obviously west to east. Now, there's a lot of railway up in the north. It was actually where the railway was invented, but a lot of these journeys are too slow or too infrequent and not reliable enough. And the government has committed £45 billion to the Northern Powerhouse rail programme, which is going to essentially link cities like Liverpool to Manchester to Bradford, Leeds, Sheffield, Hull and Newcastle. These are major cities with a huge potential, and obviously cities like Manchester are doing fantastic, but there are cities along the belt which aren't doing as well as they potentially could, and this is going to help them areas because there's going to be increased connectivity between them, and obviously there's a huge amount of business that has been done between them locations. So just to give you an example of what it will actually do, so in terms of like frequency of trains, it's going to be reducing train times from every 30 minutes down to every 10 to 15. So more frequent trains means it can hold more passengers and just increase the connectivity. But also the journey times, and this is where I think there's going to be a huge amount of value in this initiative. So, for instance, Manchester to Leeds, currently, the quickest train you can get is about 55 minutes. Once this initiative has been completed, you're going to be able to get to Manchester to Leeds in 25 minutes, which is less than half the time. And they're two key hubs which share employees. They've got offices in maybe both cities, and employees need to travel between them. So just that is going to just help the economies of these cities within them. The government actually estimates, should the North's productivity catch up to the south and the rest of the UK, it's going to add £40 billion per year to the GVA, which is quite astonishing. There should be 74,000 new jobs being created just from that increased connectivity. So it's massive news for the North, and we're excited to see what that is going to bring. The best example we can kind of discuss is the Queen Elizabeth line.
Of course.
Which has been, although it was very delayed, I think it went over budget, it has been a renowning success. So the Queen Elizabeth line, if you don't know, it's a line that runs from west to east or east to west, whichever you want to look at it, connecting, Reading through to Shenfield, and the line hits a lot of major or key areas of London, such as Paddington, Liverpool Street, Tottenham Court Road, Farringdon, Canary Wharf, and Heathrow. It's actually brought 1.5 million people within 45-minute commute into central London, which is obviously
a lot more doable.
Yeah, it's quite a large percentage of the population, actually.
Yeah.
And it's supporting an additional £42 billion a year into the economy. In fact, actually, 60% of employment growth in London has been along the Queen Elizabeth line, which is quite staggering, really. So how is the Elizabeth line impacting house prices? So we've seen 55,000 new homes directly impacted by the line. And in terms of actual price increases, it's quite staggering. We've got a 48% increase over 10% compared to 26% across the UK as a whole. In fact, actually, Rightmove released a report recently that said there's some key areas along Queen Elizabeth line, such as Abbey Wood and Stratford, that have actually doubled, which is quite astonishing, and just shows the impact that transport and these key hubs can have on property. So if we're going to use that as an example, what could the Northern Powerhouse Rail do to property prices once it's finished? So we were talking and getting some ideas together and looking at some commentary on this.
Yeah.
And we think once it's done, we're looking at a 10 to 25% premium on just the average in the north, which is a massive bonus. And a lot of the growth which happened within the Queen Elizabeth line, that growth happened before it was even delivered, before it even opened. So, this is why we want to look to get in early and make hay whilst the sun shines.
Yeah, no, of course. And then obviously the other area that ties in a lot to transport is actually just core regeneration.
Yeah.
And without this regeneration, the transport doesn't really do that much. And also without the regeneration, the transport doesn't do that much. So they have to really go hand in hand, hence why it's two of the key areas we're going to be focusing on for today. So what is regeneration? So for any of you that have been hearing this word and not knowing quite what we're referring to, so regeneration is just purely the improvement of a physical environment. So new housing, streetscapes, green spaces. So more people will want to live there, pushing up demand and therefore prices. So as older stock is refurbished and replaced with higher spec homes, the average quality of the housing rises, and so does the price people are willing to pay per unit. Then with that comes added kind of infrastructure and connectivity, so transport coming into there, but also social infrastructure such as schools, healthcare, community facilities. This raises the kind of perceived livability of an area, which is again strongly associated with higher residential values. Now, this higher livability then attracts more offices, retail, and that in turn creates jobs. Now, the higher household incomes then support the higher housing costs. So you can see how this all starts to snowball into the price growth that everyone's looking for. Now, evidence from estate and neighbourhood schemes show that nearby prices are rising when high-income households move in. And that obviously local amenities like cafes and general services will improve. So now, how do we actually spot this is the big thing. So official regeneration planning can signal long-term public and private investment. This takes form of master plans. What this does is encourages like I said, public and private investors to buy early. So not just kind of private investors like yourself, but then institutional investors. Yes. So in expectation of capital growth. Now, this in itself then will drive the prices up. Yes. Now, these new developments will include kind of more market rate units, also a higher proportion of premium homes, so luxury apartments or bigger kind of houses. And that shifts your local price mix upwards as well, so the average price in the area. Now, where demand growth outstrips supply on a basic level, the result is your net price inflation, which every investor is looking for. Now, one of the strongest examples of this that we've had is actually a sports-led regeneration. So this is where something like a big project tied to a kind of sporting stadium will increase the value of property in the area. Now, the key example of that in the UK in the last 20 years is actually Stratford. So I think you mentioned Stratford as part of the Elizabeth line. Is, yes. But over the 10 years from 2012 to 2022, so the 10 years after the Olympics, obviously with Stratford being where the Olympic Park was built, the growth on the average house price was 104%. So that's properties over doubling in value in 10 years. Now, to kind of put that into perspective, where the growth was in London over the same amount of time was actually at 66% on average. So in Stratford, a 300k property in 2012 will be a £612,000 property.
I think I saw something on that. I think of the top 10 fastest growing property prices, 8 of the 10 fastest growing were immediately around in the country. Were immediately around the Olympic Park, which is quite staggering, really, and just shows how that regeneration does impact property prices.
And it's not just the prices; it's also the rental market as well. So the rental growth in those kind of boroughs that you mentioned was at 27% versus a London average of 12%. Yeah. So you can see there where the investors that got into that project early will have made the big money now. So the only, the largest sports-led regeneration scheme in the country now is the Old Trafford area. So this is actually, it's the same guy, Sebastian Coe, leading the project. So same guy as London 2012, so it's got all the earmarks of having the same effects. The project's been backed by kind of Rachel Reeves, Andy Burnham, Jim Radcliffe and Manchester United in turn. And what this is going to include is, on a headline, is a £2 billion new stadium. That's going to be the biggest stadium in the country. So that will obviously not just attract sporting events, that will attract stuff like concerts, boxing, I know American football that's been popular in London. And so it will make it a real asset for the North and for the city of Manchester. Now, like I said, Stratford came at the intersection of the Elizabeth line and of the Olympic Park. Now, Old Trafford looks like it could be at the intersection of the Old Trafford regeneration and the Northern Powerhouse Rail. So it's got all these similar statistics. So this is how you kind of identify these areas. Now, Trafford is on a kind of 15-year master plan. So, and this is all public information. Now, we at CityRise, we do that, don't we? We go out and we look for these projects for investors. And so other comparable projects as well might be something like Universal Studios. Yes. So that's just had planning approved in Bedford, so there will be a lot of sentiment around that area. Now, it doesn't kind of have the economic factors like a Manchester and the backup in terms of transport, but I'm sure the infrastructure will come over time, so that's maybe one to look at further in the futures. So that's really what you should be looking for in an area.
I think, just going back to that, it's if you went to East London before the London Olympics, it was almost a no-go area, and I go there frequently now and in and around Hackney and areas like that, and it's totally gentrified and it looks like a different place. Not only is it quite pleasant, and they've regenerated all the waterways and there's lots of nice areas to eat and drink and retail, nice markets. But it's safer, and property prices are extortionate. They're actually some of the highest in the UK. And London. And you would not have known that if you'd have gone there before. Obviously, the Olympic Park was built. And if you go to Old Trafford, I'd arguably say that's nicer than what East London was before. And it's a blank canvas, everywhere around that, and where they're building a new stadium, it's almost industrial space. It's warehouses and land that is not going to, well, it can be built on. So it's very exciting that they've almost got this blank canvas that they can just build this incredible part of Manchester that within its own right is almost going to be another city.
Yeah, 100%, as well as it kind of links that corridor between Manchester City Centre and Trafford Park as well.
Yes.
Because Trafford Park is one of the biggest employment centres in Manchester, and it's the largest industrial park in the country.
Yes.
So that is mainly where your employment is going to come from, but being that link, it's going to turn, and I think Trafford Council's words are actually that it's going to become an interconnected district.
Yes.
So it means your transport's there, your employment's there, your regeneration's there. So this has all the perfect factors that we kind of look for in an area.
Yeah, I think investors that don't earmark Trafford as a place to invest now will probably regret that, because if it follows the Olympic Village and them boroughs, it's going to do very well for investors, and it's definitely one to look at. I mean, it's ironic that we're talking about 2026 because actually, these are decade plans, and they are for the future, but they're going to get there, and they will. And Trafford is going to look absolutely fantastic once finished.
Yeah.
So just looking at 2026, and obviously 2025 was quite a strange year in the property industry. Not bad, not fantastic, but from your opinion, Kieran. You speak to investors every single day. How do you think that the current sentiment is in the market from the conversations that you're having?
Yeah, I mean, there's been a stark difference recently because kind of just before that budget came out, people were kind of uncertain, and that came with tensions about the potential tax increases. Now, the majority of investors are using limited company structures in the minute, so we are seeing that return to confidence in the market. Now, as always, the kind of most successful investors will ignore the kind of sensationalism in the media because they know, obviously, like you mentioned, policies and trends come and go. There's a new government every 5 years, and on a 15-year investment, you potentially could even get 3 different governments in there. So the fundamentals are going to matter a lot more in the long term, and I think now that the budget's gone and people that were panicking in the lead up to that are starting to come around and realise this is a long-term project. It's not going to be that badly affected by the budget and the Renters' Rights Act.
Yeah, absolutely. I think bad news or bad media sentiment is always
constant.
It's constant, but it's before a budget, it's I'm not going to do anything. I'm going to stay away from buying.
Yeah.
And immediately afterwards, it doesn't really matter what actually comes out. It could be really bad, but it's just that kind of assurance that they know what's happened. But ultimately, like you said, a budget's every year. There's always going to be changes in government policy, taxation. Interest rates are going to go up, and they're going to go down. And property is a long-term investment, and you have to not focus on the media and focus on kind of what we've discussed on the regeneration, on these projects such as the Northern Powerhouse Rail, which they're being delivered over 10 to 20 years, and that's where you make your real money. That's your pension pot. So
exactly.
No, I absolutely agree with that. So I think it's probably worth also kind of touching on where you've obviously sold to many investors. Where do you think your investors are having the most joy? Which areas of the country do you think that there's been the best returns and the most success stories coming from?
Well, I think it goes into a bit of everything we've kind of mentioned of a lot of the areas that now are kind of well linked to the economic hubs. Maybe investors are looking for a little bit more value for money. And now with people being able to access those economic hubs easier, the property prices are coming up in the areas surrounding them.
Yeah.
So maybe 10, 15 years ago, when you looked at Leeds, Manchester, Liverpool, you would have looked at LS1 or M1, those kind of really sort of central areas. Now investors who are kind of the more savvy out of the bunch are looking at the suburbs and strategic locations with excellent transport links, because people that are working from home, if they have to make a 20, 30, 40-minute commute, they're much more likely to do so because they're only going into the office 2 days, and they're going to prioritise things like good schools, green spaces, independent shops and cafes and bars and things, and the general livability of an area. So whilst obviously you need to remain linked to those economic hubs for employment and stuff, the people in the suburbs are going to be making the money there because there is more room for growth there as well over those next 10, 15 years.
I think actually, if you look over the last couple of years, especially since COVID, it wasn't just a COVID thing where people wanted to get out of the city centres. It's actually remained, and some of our most popular projects and opportunities where we've sold out the quickest have actually been in the suburbs, not the city centre. And don't get me wrong, city centre is always going to remain a very attractive investment, and we're not for 1 minute suggesting that we shouldn't be looking at city centres, but if you can't afford that and you want to look for maybe opportunities that might give better returns, then suburban areas which are now getting better connectivity, and because of people working from home, I mean it's obviously making them very viable. Exactly. So I don't want to put you on the spot here too much because obviously that's probably you need proper conversation to do this. But is there any strategies that you think are really worth looking into now? From what you're kind of understanding over the last year and looking forward to 2026. What would your advice be?
I mean, I'll go over this in a really high level because obviously the main thing with property investment is it's a personal approach. It's about designing portfolios for specific investors and for their goals. But the shifts I'm seeing realistically is the things that are going to work in 2026 are mainly kind of a little bit boring, the stock that you're going to be looking at. So look, 1 to 2 bed units and family houses in cities and towns with like diversified job bases, transport links, especially in those regions that are going to outperform. So obviously we've been into a bit of the way to pick these regions, but the well-researched buyers among people are kind of going for areas undergoing substantial regeneration. So transport upgrades, master plans, sports-led schemes, city centre expansions like Leeds South Bank, for example. They're going to remain one of the ways to kind of beat that 2 to 3% average that you see it like across the property market. Obviously, you can see that historically within the kind of the Stratford area and other major regeneration zones across the country.
I think we get a lot of inquiries, people looking at BRRR. It's a buzzword. It's always been a buzzword. Have you got any kind of advice on that strategy?
Well, I think it is turning into a kind of legacy strategy now, because obviously the changes we've seen, even with the kind of easing rates that we've seen over the last years, the forecasts don't show any return to the ultra cheap money we saw immediately post-COVID. So a lot of the landlords that will have tried that strategy, they may have bought in kind of undervalued areas because that's where those below market value deals tend to be. So they bought there when the lending was cheap, and now they're seeing their yields squeezed because the properties haven't come up in value, the rental growth hasn't come up, and obviously they're refinancing, and they're seeing much higher interest rates. So it's been BRRR is a lot less forgiving now. So I mean, BRRRs can when done right, they can accelerate your portfolio growth. But it carries significant risks and disadvantages that many investors, especially first-time investors, underestimate.
I totally agree with that. I think that we've first and foremost, BRRRs, the best deals or perceived best deals where you're getting the cheapest property are unfortunately often in the worst areas of cities. And when you kind of put that where you're buying in an area that is not having the capital appreciation of the key areas that we kind of discussed, plus the the increasing build costs.
Yeah.
Look at our developers, and it is more difficult to build now, and it's not as cheap as it used to be. And when you put them together, you could make a case that you can make more money on a new build and just on the capital appreciation from that than the uplift of renovating a property in a worse area.
Yeah. Because even when you do a BRR strategy well, it still has fairly poor outlook in the kind of medium to long term.
Yes.
Because if the fundamentals aren't there, then after that initial uplift, you will see it tail off massively. So it'll go like this and then just start to go like that.
Yeah.
So at some point, the gradual graph of growth will overtake that. And for most investors, that's what they're then going to be looking for, is that gradual growth. So obviously, you can hit even when it's not done well, it can turn from profitable to loss-making very, very quickly. The refinance cycle exemplifies this. So it's going to magnify your profits if it's done well, but it's also going to magnify your losses. And a lot of investors can end up with capital stuck in these projects that they were promised they could refinance out and stuff. So they have capital stuck there, and that's going to delay their portfolio build by a long time. So realistically, you're going to want something with more predictable growth, higher growth figures, and better fundamentals is where we're seeing a lot of people come back to for 2026.
Brilliant. That's excellent advice. I think obviously, discussing time constraints, we will go to questions and answers. Obviously, just before that, when we're looking at an outlook for a whole year or trying to discuss a whole year previous, there's only so much we can discuss, and obviously we are here to have more in-depth, tailored conversations with investors and help build portfolios. So, just for anyone listening, please don't hesitate to pick up the phone or drop us a message, and we'll be more than happy to have a phone call or a Teams call and actually go through your own personal kind of requirements, your situation, and find something that's going to work for you. So, let's go to question and answers.
Do you think rents will go up if more landlords exit the market post-renters' rights bill?
Okay, I think rents are always going to go up. Rents recently have obviously increased massively because of interest rates. Especially landlords who got larger mortgages. There obviously have been maybe back to 2024 when they're at their peak. There was obviously a lot of properties which were barely covering their mortgage, and that had a significant impact on landlords not necessarily even willing to or wanting to push up their rents to levels they were, but they had to because they weren't covering the mortgage, and that was important. Last year is a great example of a year that we could have technically seen rents plateau because interest rates they obviously leveled and then they started going down. But they didn't. They actually increased and they continue to increase. And I think that landlords now are seeing that, with wages increasing as they are, there is an opportunity to increase rents no matter what market it is. And so my prediction would be that we're going to continue seeing rental increases regardless of any other factors within the market.
Do you think it's worth waiting until after the Renters' Rights Bill comes in on the 1st of May to buy a BTL?
No. Simple answer, because the best time to buy an investment property is 10 years ago, realistically. And so that 3 months, if you're in an area with 8 to 10% growth, you could be missing out on a lot of growth and paying that as a premium. So it's always best if you've got the capital there ready to go to make an investment, because the market does go up quite quickly, especially traditionally in those kind of January to April months post the kind of Christmas slowdown.
And obviously, if there's anything like that you're worried about, that's why we operate, and we are there to make people's lives easier and so you're not getting bogged down in these issues and the legislation and whatnot. We're there to guide you, and you can, sit at home or continue working without having to worry about that, because obviously it's going to get managed professionally, and your property is going to get looked after, and you're going to be compliant. So I absolutely do not believe that waiting is the right option.
Yeah.
Do you think that the regeneration of the Old Trafford Stadium will actually happen?
Yes, because typically when people make this much noise about stuff, that it generally is going to happen. So while obviously there will be hiccups, like with any big project like that, I don't think there's any kind of project like even the Olympic Park and stuff that didn't go off without any hiccups. But to be honest, I think the Old Trafford Stadium is kind of the jewel in the crown of the Old Trafford regeneration.
Yes.
So while obviously it is the flashy headline thing that people read, the real kind of value is going to be driven by the 15-year master plan that is in place for the wharf side. They don't pay Sebastian Coe's wages to do nothing. So that will form the main part of the regeneration. There's stuff like the Northern Powerhouse Rail. Manchester is the fastest growing economy in the country as well. So it is, yes, it's a factor, but that area is still going to come up in value massively regardless.
Yeah. I think there's too many entities involved for it not to happen now.
Yeah.
This isn't just your Jim Ratcliffes and Ineos and the Glazers and the ownership of Manchester United. And if you haven't been to Manchester United Stadium, it is old. They are a huge club. They've got huge financial backing. And regardless of their results, which obviously haven't been great in recent years, they are still a powerhouse of football. And where other football clubs are getting new stadiums or refurbing their stadiums, Man United haven't, and so there is a need there. And like you said, it is the jewel. It's going to be an iconic stadium for an iconic club. But when you've got the government, the UK government down in Westminster, alongside obviously Andy Burnham and the Manchester Council, and there's grants going in and government funding, there is absolutely no reason why this won't happen.
And final one, are you better waiting for the regeneration to finish to buy, or buy earlier, like at the start of the regeneration, or as it's ongoing?
Buy as early as you can is what I'd say. If you wait for the regeneration to happen, you're always going to be worth. It's always going to be, the property is going to be worth more. Like the example I gave earlier, if you bought in 2012 in Stratford at 300k, the property would be worth 612 by 2022.
Yeah.
So waiting to buy, you're only going to be, with regeneration, you're only going to be watching the property go up and up and up. And I'm sure everybody would rather get the same property at a lower price.
Yeah, and we I think I touched on it. Obviously, what we saw in the Queen Elizabeth line, huge price increases on property which were being serviced by the Queen Elizabeth line. Then price increases happened 10 years, they happened immediately from when it was announced up until it was obviously opened over the last couple of years. So, that wasn't just, that price increase happened just on the day it opened. No, that happened whilst it was being built. Now, obviously, when spades are being put in the ground and there's something tangible there for people to see happening, obviously that's going to increase them quicker. But you need to get in there as early as possible. If you're confident in kind of the advice you're getting, if you're confident in the project and what's happening, and you're confident with the evidence that obviously we can show, then there isn't any reason why you would wait, because ultimately, if you then revisit that and want to invest in the future, you're going to be paying a premium. And it's as simple as that. Mm-hmm. Brilliant. Well, thank you for watching.
Thanks, guys.
And hopefully speak to you soon.
Cheers.